welcome to Tax News You Can Use, where we take complex tax issues and provide quarterly updates and tips to help you and your business succeed. I'm your host, Mariana Moghadam, tax partner at SobelCo, and this is Doug Finkle, tax director at our firm. Today we have some great topics to go over, so gear up as we give some updates on federal, state, and international topics. So, Inflation Reduction Act passed the Senate on August of 2022, and one of the biggest topics in that act was the corporate alternative minimum tax. Doug, can you explain what that entails and how that's going to impact corporations?
Sure. As you said, it's a corporate provision, and it's sort of a comeback of the old alternative minimum tax for corporations. In 2018, under the Tax Cuts and Jobs Act, the corporate alternative minimum tax was eliminated. Now it's back. It's called the corporate alternative minimum tax. It only applies to corporations and only those with a large amount of income. So in order to be subject to this provision, you have to have over $1 billion of annual what they call adjusted financial statement income, which is financial statement income subject to certain adjustments. Only those companies are subject to this tax. And in addition to that, if you're owned by a foreign parent, the threshold becomes $100 million. So it's a 15% tax. You are allowed your alternative foreign tax credit, and it's also adjusted for certain things. Instead of book depreciation, you can use tax depreciation, but that's only going to affect the very largest companies. So a lot of taxpayers are not going to be affected by this provision.
Right. So that's $1 billion is a big number.
Yes, it's a huge number.
The other provision was the stock repurchase, again, for corporate tax. What does that mean?
Sure. So this is another one that's generally going to affect only large corporations because it's only subject to publicly traded companies. And what it is a 1% excise tax on stock redemptions, which is basically when a corporation buys back its own stock, it's considered treasury stock. So that type of stock will be subject to this provision. In addition to stock repurchases, if a company buys back the stock, if it owns more than 50% of a foreign affiliated, then that stock could be potentially subject to the buyback as well as certain foreign subsidiaries. So again, this is not going to apply to a large number of taxpayers.
Gotcha. Another provision that was included in Tax Cuts and Jobs Act was the amount that the investors in a pass-through entity could deduct on their individual tax return, which was called the pass-through loss limitation. The Inflation Reduction Act it emphasizes on that and does not eliminate it, but extends it to 2028. Can you talk about the limitations and how much they are now?
Sure. So originally, when it was put into play, it was originally put into place under the Tax Cuts and Jobs Act, and at that time, the limitation on losses. These are losses that any individual can utilize for any tax year was $250,000 for a single or $500,000 for married couples. Mm-hmm. And what would happen is if you couldn't use that loss, it would turn into a net operating loss in the carry forward year. So what happened is it was originally supposed to be in effect starting in 2018, but because of the COVID-19, they put out law to delay the implementation until beginning in 2020. What this tax law does is it extends it out to 2028. So it's expanded. It was originally supposed to expire at the end of 2025. Now it'll go to 2028. And as you said, each year it's adjusted for inflation.
Right. So the limitation for 2022, which is the next compliance season, would be $270,000 for individuals and $540,000 for married filing jointly. Do they have any credits for research for small businesses? Is that still in effect, or was there any adjustment on that?
Yeah, so there's what they call a provision for, it's usually going to apply to your biotech companies. So those are companies that really aren't making any money, don't have a lot of receipts in the beginning of their operations, that are not making a lot of money, not paying taxes, and have net operating loss carried forward. So, and this is a provision that's been in effect. They've just changed it to a certain extent. So a taxpayer who's had less than $5 million in gross receipts over a 5-year period and no gross receipts going back to that 5th year could originally take a $250,000 credit against their payroll tax. What's been changed is that limitation is being increased starting in 2023 from $250,000 that can be used against payroll credits to $500,000. So that's a big jump, and it's a big help to pharma and biotech companies that are in the startup phase.
Okay. The Inflation Reduction Act had a big number of provisions for green energy. Was there anything for the residential people, residential homes and things like that?
Yeah. So for those taxpayers that are making what they call energy efficient improvements on things like putting in energy efficient doors, windows, an energy efficient HVAC system, or things like that, metal roofing or, insulation materials, would get a lifetime energy credit. I think it was originally somewhere maybe between $300 and $500. So that's been extended, but also the lifetime credit is now at $1,200. So if you were previously limited by the lifetime credit, now you have additional credit that you can use going forward.
Great. Are there any other energy efficient provisions for commercial buildings or builders of residential homes?
Yes. So there was put into law this thing called the 179D deduction for energy efficient commercial buildings. And originally the amount was $1.88 per square foot. Now they've changed that, so it's now up to potentially $5 per square foot, so much more robust. It's a little bit of a complicated formula in how you determine that, but that's essentially it. And they also expanded it to many more taxpayers. Originally, it was just for commercial businesses and governmental entities. Now it's been expanded to entities like charitable contributions can take it, churches can take it, private schools and universities can take it. So they expanded, not only increased the amount of the deduction, but they also expanded it to much more businesses and entities.
Good. Also on the builders of residential homes, they do get a credit of, I believe, $2,000 per unit. So that's also extended. Anything about the purchase of electric vehicles?
Yeah, so the purchase of electric vehicles is they have put into place. The credit is now up to, I believe it's $7,500 for a new vehicle, but they also put in a new credit, so now you can get that credit on a used vehicle of up to $4,000. So energy efficient vehicles are they're trying to incentive purchase of energy efficient vehicles, and most of the provisions we have talked about so far start in 2023. Mm-hmm. This particular provision starts as of the date it was signed into law, which was August 16, 2022. Mm-hmm. So a little bit of help, because as we know, the electric vehicles tend to be a little bit more expensive than the regular gas vehicles. So this is to help taxpayers and incentivize them to buy electric vehicles.
Right. So these are all the provisions that are included in the Inflation Reduction Act. There were a lot of other items that were included but did not pass. One of which was making a lot of noise was the like-kind exchanges, or as we know, 1031 exchanges. Those, they were proposing to eliminate that, but that didn't go away, and that's a great thing for real estate industry and people who invest in properties. What is the other items that did not pass the provision?
Sure. The big one was what they call the SALT cap, is that the limitation, individuals are limited on the amount of state and local taxes they could deduct up to $10,000. A lot of people were hoping that would get removed and back to what it was, where you had an unlimited deduction. Another one that didn't make it, there was a lot of talk about, is a carried interest, that those managers of investment portfolios that got a ownership interest for their services, if they held the stock for 3 years, they would get capital gains treatment as opposed to ordinary income treatment. So that was one that was on much talked about but did not make the final cut.
Right. So that's still in effect.
Correct.
And the other item was the capital gain tax rate. which they were proposing to eliminate the capital gains tax rate and make it as the ordinary tax bracket, but that did not pass.
You're right. They wanted wealthy taxpayers who made over a certain amount of income to pay ordinary rates on their capital gains. But as you said, that did not make the cut for the passage of the law.
Right. The other topic that we want to talk about is the IRS tax inflation adjustments for tax years 2023. So what are the changes to the, so every year IRS adjusts the standard deduction limitation. What is that limitation for 2023 now, Doug?
Sure. For married taxpayers, the standard deduction is increased to $27,700. For single taxpayers, it's $13,850, and for head of households, it's $20,800 for tax year 2023. In addition, they also adjusted what they call the marginal rates, as Mariana mentioned, that every year a lot of these tax brackets and standardized deductions get adjusted for inflation. So for the highest 37% bracket for singles, to be in that threshold is $578,125 for 2023. For joint filers, it's $693,750, and for head of households, it's $578,100.
The other adjustment was made to the alternative minimum tax. What is that level now?
So I think they changed that level to about $80,000, somewhere in that range.
Okay. Then there was also a wage cap for Social Security tax. So Social Security tax, there are two components to that. One is the FICA, and the other one is for Medicare wages. The Medicare, there's no limit, which is that 1.45% by employee and employer. What is the limit for the 6.2% now?
So that's been increased to $160,200. So for 2023, after $160,200, you will no longer be subject to FICA.
Right.
And they also increased the percentage that this isn't really related to taxes, but there was a big increase to the Social Security that people will get starting in 2023. I believe it was like an 8.7% increase,
which is
to keep up with
the inflation. That's great. Was there any adjustment to the retirement plan, the 401k and SOAR?
Yeah. So the retirement plan is something that gets adjusted every year, and I'm not going to hit every one of them. I'm going to just hit the most popular one, which is everybody's 401k. So the 401k limit for 2022 was $20,500. For 2023, it's going to be $22,500. And then they have a thing called catch-up distributions. If you're over 50, they allow you to make additional contributions because you're getting closer to retirement. The catch-up contribution in 2022 was $6,500. For 2023, it's going to be $7,500. So you put it away a little bit more next year.
Is the earned income tax credit still available for taxpayers?
Yes, it's still available, and again, that's something that gets adjusted for inflation every year. And I think they also did some other adjustments on like qualified fringes and health savings accounts. So there's many different items that get adjusted for inflation.
Right. Another big topic that people are interested in, and they tend to scramble through around the end of the year to make plans, is the estate tax exclusion. There's always a big talk around it, if they are going to eliminate that or increase the limit. So what is the limit for 2023 now? Was it adjusted, or what is the rate?
Yeah, so the limit for 2022 was $12,060,000. For 2023, it's going to be $12,920,000. And then if you're married, you basically can double that with your spouse. So it'll be double the amounts that I just said if you're married. In addition, they also increased the amount that you can gift annually from $16,000 in 2022 to $17,000 in 2023.
Right. So this annual gift exclusion that you're talking about is not included in the lifetime exclusion. This is all separate.
That's correct.
There was an adoption credit for people who are trying to adopt a child. did that limit change, or what is the limit now on that?
Yeah, so that limit was $14,890 in 2022. It's been increased to $15,950 starting in 2023.
Right. So, as we know, the personal exemption was eliminated with the Tax Cuts and Jobs Act. That's still eliminated. There's nothing for 2023. Is there any limitation on itemized deduction as it was in the past?
No, the personal exemptions and the itemized deductions, they have kept the same, and they're unlike previous provisions, there's no phase out.
Okay, great. Usually there are some lingering tax extenders towards the end of the year. Has there been any adjustment on those, or there's no tax extender that's at this point?
So, a lot of the tax extenders traditionally every year get extended in what they call the lame duck session of Congress,
Right.
which is after the midterm. So we're approaching that time right now, and they expect there to be an omnibus bill coming out before the end of the year, and a lot of the tax extenders are expected to be in that bill. A lot of the tax extenders generally include these energy credits that we talked about previously. They usually are put into law and they expire, but since a lot of them were extended by the Inflation Reduction Act, we're not going to have as many as we usually have. But some of the ones that they're talking about as far as the tax extenders is for things like for 2021, 2022, you could deduct 100% of your business meals as long as they took place at a restaurant. Mm-hmm. So that might be one extender provision that you think about extending for 2023. Another one that might be on the extender package is for the past couple of years, taxpayers have had the ability to take charitable contributions that they can't itemize their deductions above the line. So you can take, if you weren't itemizing the deductions and you had the standard deduction, in addition, you could take up to a $300 charitable contribution credit or $600 for married as a deduction above the line. So that might be another one that is on the extender package. Another popular one that people think may be on the extender package is there's something called bonus depreciation.
Right.
And what that is the ability, if you you purchase a capital asset, normally you have to depreciate that asset over the life of the asset. For example, machinery and equipment has a 5-year life. Bonus depreciation allows you for federal purposes, instead of deducting it over 5 years, to take 100% deduction up front. That's supposed to start phasing down each year by 20% starting next year. So next year, instead of being able to deduct 100%, you'd only be able to deduct 80%. So many people think that might be something they may take in the tax extender bill to continue to allow people to deduct 100% of their capital purchases of equipment.
Right. So bonus depreciation is going down to 80% effective for tax year 2023 and then go down after that.
Correct.
So Doug, there's been a lot of talk about employee retention credit, which came because of the COVID, and that was an incentive for employers to keep their staff employed. Is that still valid, and can employers still get a credit for employee retention?
Yeah, so the employee retention credit, which, as you said, was put in place due to COVID to encourage employers to keep their employees on payroll, which you could qualify in one of two ways: if you had a significant decline in gross receipts, or you had a full or partial shutdown due to a governmental authority. Mm-hmm. That program ended in the third quarter of 2021, except for companies that were considered employee restarted companies, which were companies that came into existence after February 15, 2020, and had less than $1 million of receipts. So a lot of people are saying, well, it's ended. Can I still take the credit? Well, yes, you can, because these credits get filed on your payroll tax return form 941. So although the time for originally filing for these credits has passed, you could always amend a return up to 3 years and claim these credits on a form 941X, which is amended employer payroll tax return.
So that's 3 years from the time you filed your original 941.
Correct. So, for example, if you filed your original 941 in 2020, you have up to April 15th of 2024 to claim the credits, because the way they judge the 941 filings, even though they're quarterly, they deem them all to be filed by April 15th of the following year. And then for 2021, you have up till April 15th of 2025 to claim your credit. So there's still plenty of time to claim these employee retention credits. But companies should be aware and make sure they do it, because once it's gone, once the statute of limitations is gone, you don't have the ability to do it. And the other thing companies should be conscious of is that there's a lot of advertising out there encouraging companies and calling companies to claim the credit. Make sure these credit claims are valid, because the IRS has put out notices saying that they're going to be looking into these credits, and that if you're not, these aren't allowed, you took them, you shouldn't have, you're going to be subject to interest and penalties. As a matter of fact, we've heard recently that of the 80,000, everybody's heard about the 80,000 agents that are going to be hired, is that there's going to be a decent amount of them that are going to be tasked with auditing these employee retention credits. So make sure that, don't definitely take these credits if you're entitled to them, but just be careful that, of taking something that you're.
Yeah, there are some companies that are taking very aggressive positions, so you want to be careful with that.
That's correct.
Another thing that President Biden is pushing for is the student loan forgiveness. How does that work, and what is it all about?
Sure, and if haven't been keeping up with things going on with the student loan credit that's about to go to the Supreme Court, so we'll know soon whether it's going to be allowed or not. But as originally enacted, the students who had Pell Grants were eligible for $20,000 of forgiveness of their student debt, and those without Pell Grants were allowed up to $10,000. Big question is that it's considered forgiveness. Is it taxable? Right. Well, under the American Rescue Plan, up to 2025 was put into law that the student loan forgiveness would not be taxable.
Right.
But from a federal perspective, we don't know how the states will do it.
Mm-hmm. So this wraps up our federal tax update section, and now we're going to be talking about the state and local tax provisions for this quarter. One big topic for the state and local taxes are the pass-through entity taxes. Mm-hmm. Since we last spoke, there have been a lot of states that are adopting that. And as you remember, this is the tax provision where the state taxes can be paid at the entity level. And this way you get a deduction for the federal purposes. New Jersey still has it. New York has it. What other states have adopted it?
Sure. So there's 29 states that have some form of a pass-through entity tax. Mm-hmm. There are 3 other states with proposed legislation. There are 9 other states that don't have a owner level tax, so they wouldn't have it.
Right.
And there's 10 states that currently don't have any proposed legislation related to a pass-through entity tax. I actually have my AICPA chart up here. I don't know if you can see it on the screen, but if you look at it, reads a lot like a political electoral map, an election, with red and blue for Republicans and Democrats. So there's a substantial amount of entities that have adopted this legislation. And, just a couple of things, a couple of changes to keep in mind for some of the states. So California, which has an elective pass-through entity tax, made a few changes this year. One is in addition to allowing pass-through entities to claim the tax, i.e. an S corporation or a partnership, single member LLCs are now eligible to take a pass-through entity tax. The other thing they did is there was a little bit of a quirk in the original law for California. Is the PT, what you get is a credit when you take the pass-through entity tax, and you get that on your personal return. Mm-hmm. But the way their credit was set up originally is it came after your credit for taxes paid to other jurisdictions. So a lot of taxpayers never got to their PT tax and never got to use their credit for taxes paid to other jurisdictions because the PT credit came first.
Right.
Well, they changed that to make it the way it should be. Is first you get to utilize your credit for entities, taxes paid to other states, and then your PT credit comes after. So that was a favorable taxpayer change. The other thing they changed is you're no longer, if you're going to do a PTA election, you're no longer required to withhold California tax on non-residents, which is an issue in New Jersey that we'll get to later. And the reason they took it away is you're basically paying tax twice.
Right.
You're paying the tax on your, for your entity at the PTA level, and then you're also paying tax again as a non-resident. So they removed the non-resident withholding provisions, which will, because all it did is, the taxpayer would, when they filed their personal return, they would get a refund because they essentially paid tax twice. So that eliminates that. A favorable thing New Jersey did is they sort of followed suit. You're no longer required to withhold on non-New Jersey residents if you're going to make a PT election. So there's a couple of favorable changes there. In addition, New York and New York City have put in some changes to their tax law. One is New York had originally adopted a PT regime. Now New York City has a PT regime as well. And they also put into place what they call New York State and New York City PTs. And what that means is if you have all you have is resident New York or New York City partners, you can calculate your PT tax on your entire income. Previous to that, you could only calculate the tax on your income that is allocated to that state or to New York. So now that they put in that provision, if you have only New York state residents or New York City residents, and instead of just claiming the PT tax on the New York portion of your income, you can claim it on your entire income, which is very taxpayer.
Yeah, New Jersey has something similar to that also. And also for New Jersey, starting in 2022, if you have any overpayment for your pass-through entity tax paid to New Jersey, you can carry it forward to 23. This was not allowed for the years prior to 2022. Also, New Jersey has the same thing, that you can pay the PTE based on your all sources if you have New Jersey resident partners. All these pass-through entity taxes are elective, so you have to make sure that you make the election at the appropriate time, so you can take advantage of that.
Yeah,
so be cognizant of that.
That's
make
a
sure
good point.
The elections are done,
yeah.
And also there are estimated taxes that needs to be paid. So there needs to be consultation and planning around that.
And as you said, Mariana, you need to make the election, because if you don't, a lot of states don't allow you to go back and make it retroactively, and this is a permanent loss of a deduction if you miss it. So
but mostly, for the most part, the elections are done on an annual basis.
Correct.
So if you haven't done it for 2022 for one state and it's late, you can make sure that you make the election for 2023.
Right. Well, although there's a couple of states that are a little quirky, is California requires the election to be made in, if I was going to make an election, for example, for 2022, I had to pay, the way they do their election is through the payment of the estimate. I had to make that payment by June 15th of 2022, or else I would be considered late. And same with New York, is their requirement was, it was actually March 15th of 2022 to make the election. So, and then they extended to September 15th, 2022. So there are a few states that don't wait to the due date of the return to make you make the election. They make you make it in advance.
In advance, exactly. There's one other program that New Jersey is bringing back, and that's the New Jersey Anchor Program. Can you talk about it, and what is that involved, and who benefits from that?
Sure. So the New Jersey Anchor Program replaces the New Jersey Home State Rebate Program. So a couple of the points that are significant in it is they increase the threshold. So now if you have up to $250,000 of income, you can get a property tax rebate, where the income threshold was much lower. So many more taxpayers can be able to qualify for the rebate. They also are, from some odd reason, they're doing it based on your 2019 tax return, not your 2021 that you just filed. So the income threshold is as of 2019 to qualify. You have to be under $250,000 of income. Mm-hmm. You have to be either a homeowner, is defined as your principal resident, or you have to be a renter as of October 1st, 2019 to qualify. And in order to be your rental unit to be considered valid, it has to have a bedroom and a kitchen. Right. So it has some certain requirements. And the home's got to be your principal home. It can't be your vacation home. It can't be a second home. It can't be being away at a dorm. It's got to be your principal residence. So, and then the due date for doing this is December 31st of 2022. So if you don't get it in by December 30th of 2022, then you're no longer eligible to apply for the rebate. And they said the rebate should start to be sent out sometime in May of next year. Now, for renters, the maximum they could get is $450. If you're a homeowner and you have over $150,000 of income, your max is $1,000. If you're a homeowner under $150,000 of income, you can get up to $1,500. So, it's a bit of money that a lot of residents are going to be able to claim in New Jersey.
Right. So as Doug mentioned, this is based on your 2019 that taxable income. So if you don't remember what that number was and you cannot find it, just reach out to us. We may be able to assist you with that. Are there credits that the states are allowing?
Sure. So New York has, for businesses operating in New York, they have this capital credit, which is basically for taxpayers who expended money due to COVID that was out of pocket. And it's up to a $25,000 credit you get. You have to submit an application for that credit in order to qualify. So you have to qualify. You have to save your invoices so this way you can support the amount that you spent to COVID-19 expenditures. And the good thing about this credit doesn't say that because you took out a PPP loan, you're excluded from taking this credit. So if you're a New York business, small business is considered under $250,000 of income, then this is a good credit to look to.
Yeah, these credits are definitely helpful for the taxpayers, and they should be looking into it.
Yes, absolutely.
Right. So that wraps up the state update, and there's not much in the international sections, but there was one big thing in 2021 tax compliance that had the tax preparers up and about, and that was about filing the forms K2 and K3 for international purposes. Has there been any update on the filing requirement, or is there anything in the proposed instructions for the filing of K2, K3?
Yeah, so something that came out recently was when the K2, K3 came out, most people, just to be safe, to make sure they're in compliance, filed the K2, K3 form anyway, just to be safe. So they recently came out with some limitations that if you meet these requirements, you don't have to file a K2 or K3 for your partners or shareholders. So some of the requirements is that you have no foreign source income, pay no foreign tax, or have any ownership in a foreign entity. The other requirement is that all your partners are either U.S. citizens or resident aliens. That's another requirement. The third one, they said that, if you had passive foreign source income and you had less than $300 of foreign tax credit, that would exclude you from the K2, K3 filing as well. And they said if you met all these requirements and you sent out notification to all your partners, either by mail or electronically, meaning email, 2 months in advance of the due date, that they would not be getting a K2, K3, and that 1 month before the due date, you did not hear from any partner saying they wanted a K2, K3, you were not required to file. Now, they said if some partner requested, you made all the requirements and you were not otherwise required. If a partner asked you a month before the due date to supply them with a K2, K3, or sometime by the due date or after, that all you would have to do is simply provide that partner with a K2, K3, and you wouldn't have to provide it to all your other partners.
Right.
So that's a big relief because last year almost everybody filed a K2, K3 just to be on the safe side. Yeah. So hopefully a little bit help in terms of cutting down on the compliance for this busy season.
Great. So, Doug, is there anything else that you would like to mention before we wrap up?
No, I think we covered a lot. I appreciate us having me aboard and doing this again. It was a lot of fun.
Thank you, Doug, and for taking the time out of your schedule and sharing all this great information with us. This wraps up this session of Tax News You Can Use. If you have any question that you can contact us. And for any additional information, please visit our website at SobelCoLLC.com. Stay tuned for our next quarterly update.